Panel. Best opportunities in ETFs in 2024. We're going to be talking about the exciting trends this year that we've seen, the thematic ETFs, the inverse and leveraged single name ETFs. If you don't like long NVIDIA 2X, you can trade long NVIDIA 3X. We're also going to talk about the premium income equity ETFs, which have exploded in AUM. And we're also going to talk about the incredible debut of the Bitcoin ETFs. So let me start by having the panel introduce themselves.
David Schulhoff. I'm the founder and CEO of the MUSQ Global Music Industry ETF.
Ed Rosenberg. I'm head of ETFs and funds management at Texas Capital. A little background, it's my 19th year in the ETF space. So I didn't know the gentleman's name who was on the panel from Vanguard previously, but I've been gone so long, he's not there. So that's where I started and been around for a while.
Hi, I'm Jeff King. I'm from Macquarie, where I'm a portfolio manager on the Global Natural Resources team. Been in the business for about 20 years, but it's the first ETF conference, which we just launched our first active ETFs.
My name is Tom Bonville. I'm joining you from Clear Street. I run their equity derivative sales team.
Great. I am Sanjay Chablani. I'm the former head of ETF trading at Bank of America Merrill Lynch. Now I'm the founder of Nirvana Capital. We invest in public equities, ETFs, and private equity. Let's start off by talking about the thematic ETFs and the explosion of those. Obviously, a few years ago, I think Kathy Wood was an innovator with her innovation active ETF, thematic based. And we're going to start it off and kick it off with David to talk about his MUSQ ETF, which is based on the music industry. And, you know, David, if maybe you could tell us how this came about, and what everyone wants to know here is if you buy the ETF, can you get Taylor Swift tickets?
That's a common question I get asked a lot. And the short answer is no, but you do get exposure to Taylor Swift, all right? Because we have Universal, we have Live Nation, we have Vivid Seats, we have CTS Eventum. All those four companies are heavily invested in Taylor Swift. So I've been investing in public and private companies in the music sector for the last 25 years. I've run a number of publishing companies, record companies, live music and ticketing companies. I was the president of live music at a company called Live One. We own Slacker Radio and Podcast One. We put Slacker Radio in every Tesla car. If they're Tesla owners, that was our distribution partnership with them. And about 2 years ago, I just recognized how many exciting music companies there were that were public around the world, but there really wasn't a convenient way to invest in them. You know, I've been an investor in a lot of LPs for a long time, so music's been very illiquid for investors. If you're an LP in Blackstone or KKR or Apollo or Providence Equity Partners, you have your money locked up for like 10 years, 12 years. You have minimum, net worth requirements and so on. So what I wanted to do was create a completely liquid product. And so we launched last year the first pure play music ETF, which now trades on the New York Stock Exchange under the ticker MUSQ. We have 40 companies in the fund across streaming, content and distribution, live music events and ticketing, equipment and technology, and satellite and radio. 40% of the companies are domestic, many names that you would know, like Warner Music Group, like Live Nation, like Spotify, but we've got 60% of the fund are all international companies that are really important to music that you may not know. Companies like HIM in Taiwan, companies like CTS Eventum or Believe or Avex in Japan or Amuse in Japan. We have 14 K-pop companies like Genie Corp and Kakao, the biggest streaming services. And so music today is really the most undervalued media asset. It represents the best content story in the history of media. That's not me saying that, that's JP Morgan saying that. And if you read Lisa Yang's report, she wrote the Music in the Air report in Goldman Sachs, the industry is doubling to $180 billion in the next 6 years. streaming is cheap compared to what you pay for HBO Go, for Hulu, for Disney. So all of these companies are now raising rates for the first time. Spotify crushed earnings two quarters ago. They raised their rates by $1. They're going to continue to raise rates, and all these record companies and labels are all benefiting from these rate hikes because 70% of all the revenue is contracted to them. And so I wanted to create a fund that captured all this growth, all this innovation around music. And so today you've got all these live music and ticketing companies. You have all the streaming stocks, companies like Spotify, Click Digital. You got all the live music and ticketing companies like Live Nation, like CTS Eventum and Vivid Seats. You have tons of K-pop stocks. You have all the equipment and technology companies that are driving AI and driving blockchain. Then, of course, you have all the satellite and radio companies. So if you want exposure to music, take a look at the fund. It's a very convenient way to get total liquid exposure to the music industry.
What's amazing is like the holdings list has the Mag 3, Apple, Amazon, and Google. So
all the companies in the fund generate more than 50% of their revenues from music, unless they're a top 5 player or control more than 10% of the global market share in any of those categories. So Apple, Amazon, and Google are after Spotify and Tencent. They're the third, fourth, and fifth largest streaming companies. But if you look in the fund, the big names are capped at 5%. So no name, the entire fund is market cap weighted. No single stock can be more than 5% of the fund. No company can have a market cap less than 100 million. It has to have daily trading liquidity of $500,000 a day. So that what that does is it creates a really nice cross section of small cap, mid cap, and large cap companies. All the companies in the aggregate are in the trillions in the fund, so you can invest any amount of capital that you want. It's very liquid, but those big names are capped at 5% each.
David, talk a little bit about, and I didn't know this until we spoke, about the dividend. So the royalties for some of these catalogs, so the ETF pays a dividend.
Yes, the ETA pays an annual dividend. We do have all the royalty trusts in the fund, companies like Hypnosis, which just shot up in the fund because Blackstone just took it private, companies like Reservoir. We have all the music publishing companies that are parts of Universal and Warner Music Group and Sony, all these K-pop companies like Hybe, JYP, YG+, SM Entertainment. They all have big publishing companies. They're heavily invested in our business. They own all the rights to like Justin Bieber and Ariana Grande. And so by buying the fund, you're getting exposure to all these music publishing companies, and so that are all making these acquisitions today, and they do pay out a dividend.
And that's great for like not correlated to the market, your long music royalties. So
yeah, music is very much a hedge against inflation. It's very much uncorrelated. Look, streaming is growing at 11 to 13%. Recorded music is growing at 10 to 14%, and it's growing as high as 25% in the emerging markets. So we think music is a very exciting thematic growth play. We think it should be part of everyone's portfolio. Music's simply too big to ignore. And just take a look at some of the companies the last 2 quarters. Sphere, Live Nation, Spotify. These companies are all on a tear. They're all up anywhere from 40 to 70% for all the reasons I said. Live music is on fire. People want experiences. I don't know if you guys have been to Vegas yet, but the Sphere is amazing. Go check out the Grateful Dead with John Mayer. That's happening now. Or that's awesome. Taylor Swift, Beyonce, these tours are crazy. I mean, I took my daughter to see a Morgan Wallen show on Friday. I don't know if you guys saw Morgan Wallen at MetLife. He sold out 2 nights, 90,000 people each night. Tickets in the pit were like $3,000. I was lucky. I got the head of the label to give me free tickets. But people are just paying up for experiences, and that's why you're seeing all these live music and ticketing companies really perform very well. So that's what we're about. Anyway, if you like music, take a look at our fund.
great. We're going to shift to Ed Rosenberg here, who promised me he was going to wear a cowboy hat today.
I would have. If you brought one, I'll wear it. Anyone have one? No?
Maybe we could shift to the Texas capital-based ETFs that are thematically domiciled in Texas. So fun fact, TXS is one of the ETFs. Tesla and GameStop are part of the ETF. I mean,
What
the
more could you
ultimate
want?
meme ETF.
I don't know if Tesla's a meme. I mean, maybe Elon Musk is. All right, so I'm going to point out that my kids do not think Texas is as cool as K-pop. I just want to point that out. But realistically, so Sanjay and I were having a discussion, but is Texas really thematic or is it not? Because what is thematic and everything gets dumped into it. So I have this slogan right now, we're the home of Texas ETFs. We have 3 ETFs. 2 of them are centered on you must be headquartered in the state of Texas. The third one is about oil rights in Texas. If you pull it out of the ground, that's how you're weighted. So it's not just Texas companies. There are 4 foreign companies out of the 31 in the product. But realistically, we talk about Texas, it's going to create a lot of thoughts in your head, like cowboy hats, or we can get some Lucchese cowboy boots if anyone has $3,000 to spare. But realistically, what is Texas? Texas has been the fastest growing economy in the U.S. for the last 20 years. It's the #1 exporter in the U.S. It is the 8th largest GDP in the world. The only state larger is California, and it's going the wrong way. Texas is catching up, whereas California is shrinking because all the companies are moving to Texas and people, by the way. But why is that? It's because there's no state income tax on corporations or individuals, right? And if you think about that, that can be a help. And it's not necessarily a help to Tesla that move there, but it could be a help to the smaller companies in there, like GameStop, that every now and then goes to a big company for a couple days and then goes back to a small. But if you look at the business-friendly environment and leave out politics, Texas is one of the most business-friendly states out there. And when you think of the U.S., we don't think of individual states as being a tailwind. But if I name the fund companies that have cheaper labor force and don't pay state income tax and just put companies in there like that, we'd all think it's a tailwind. But if I call it Texas, it becomes thematic. And if you guys are curious, the cost of living, I live in the nicest part of Dallas with an apartment. Nice, large 1-bedroom is $1,900. Can anyone get that in New York? Can you raise your hand if you have one for that? Anywhere, within like a 4-hour drive. No? That's part of the reason too. People want to stay there, and there's like 300 days of sun a year, and it's warm most of the time. Minus like the week and a half of freezing ice that they have. Just don't be there for that. But realistically, people want to stay there. They're moving there all the time. And because of that, there's a cheaper workforce. Companies continue to expand in Texas. You know, one of my guys is from Austin, and his name's Austin, which is fun. But I've never seen a city grow that fast. It's the only city in the state that's really expensive. But if you think of all the companies that are there, it's become a tech hub, right? How many people knew CrowdStrike is headquartered in Texas? What's going to happen over the next 10 years with AI? I got one hand. It's great. With AI, right? As AI becomes more important, companies like CrowdStrike, protecting data is going to become so much more important. So the last piece of this is I'm going to talk about. So music has a lot of the tech companies in them. That's the one thing Texas doesn't have. Now, all of you, if I said, do you think energy is the largest sector, would raise your hand in TXS, but it's not. Consumer discretion is the largest sector because we built it for today's economy, not yesterday's. And if you build it for today's economy, the way we sort of decide how our sector weights start is we look at each sector's impact to the state's GDP, and that's how we start. So we're actually trying to reflect the true growth of the economy, not just because Tesla moved there and got large. So we'll have a discussion on what is thematic later, which I would argue we're not. But if you're curious, the problem with thematic, if anyone in this room would be kind enough, on their own time or now, whenever they feel like it, look up Morningstar and put in the ticker TXS. It'll say that we are a mid-cap blend fund, but they put us in a large-cap blend category. If anyone can explain the logic behind that, because even when I asked, they said, you're categorized correctly. Anytime you start putting people's votes in there, how do they really categorize thematic, and is it really thematic? That's where it becomes more of a problem.
That's great. We're gonna shift to Jeff King here, the portfolio manager of the PWER ETF, the Power Transition ETF. Jeff, maybe you can talk a little bit about the genesis of the ETF. I saw First Solar's in there, and the impact with AI data centers that we expect to see.
Yeah, you bet. Well, first, as a resident of Texas, you got me pretty fired up to head back, even though it's 104 degrees right now. So, but yeah, so the genesis, again, I'm a portfolio manager on the natural resources team at Macquarie. And one of the things we noticed was developing is one of the biggest sector or tailwinds for our sector is the energy transition. And we really felt that people were not correctly looking at the energy transition. When I say energy transition, they instantly go to clean tech or renewables. That's part of the energy transition, but there's a bigger thematic within there. And so if you look at the IEA data, they estimate 150 trillion needs to be spent between now and 2050 to foment this transition. Where's that going to be spent? There's also, at loggerheads with that, about 4 billion people in the developing world living on less than $5 a day that are entering and demanding higher living standards. That's a draw on energy. So you have these two things pulling at the same time. Well, what we've realized and what we're starting to see is people want cheap, affordable energy. So it's less dependent on actually where you're getting the energy from, and the focus is moving to where the emissions are coming from. And so taking all that into perspective, where are we going to need to spend this money? Metals and mining, so copper and other metals like that are important for the energy transition. Oil and gas will continue to play a substantial role under any IEA scenario between now and 2050. You'd still be pulling 50 million barrels a day, even their net zero scenario. And then renewable and clean tech energy. And so how we look at our portfolio is about a third. So you mentioned first solar. A third of it would be traditionally what you think about as an energy transition portfolio. A third of it is responsible energy producers. So no matter what, you're going to be using oil and gas. You know, it's pretty ingrained in everything we do around here, and there are various reasons from an energy density perspective that'll continue to be used. So we analyze all of the oil and gas companies out there and figure out, okay, who is making fuels, that could be renewable liquid fuels, that have a low carbon footprint that will continue to be used, and who's producing oil and gas in a manner that's responsible. How do we define responsible? Limited water usage and discharge, limited emissions, so flaring and venting of methane, which has become a big thing, what we call responsibly sourced natural gas. And then the last third of the portfolio are all the metals that are going to be required and other materials for the energy transition. So you probably hear about rare earth metals, you know, anything that's making magnetics. Copper is a big piece. Between now and 2030, you know, copper demand is projected to go up by 50% if we're to hit some of these targets. Well, you probably have noticed copper prices are absolutely exploding. And meanwhile, on the supply side, no one wants to invest in a copper mine for environmental and geopolitical reasons. So there are a lot of tailwinds for this. We launched it in November. It's done quite well. We still think it's early innings, and as a thematic, this is something that's going to continue for decades, and it will be volatile as it's dealing with the natural resource sector, which we're all familiar with, has a fair amount of volatility with it, but it's something we're excited about and continuing to get the word out on.
I read something really interesting. The cost to do a Google regular search versus a AI search is 10 times more for the AI search. So these data centers are going to be buzzing. So I totally see the point of energy transition, and just the real AI play might be energy, is what they're trying to say.
I think that's a fair point. You're starting to see some of the energy names reflect that, as copper as well, with the AI build out and everything that needs to take place. And you know, one of the big assumptions that you see from a lot of these models on the energy transition and how we're going to lower our carbon footprint, they're all assuming increasing efficiency. Not to get too far into the weeds, but there's something called Jevons paradox, where as you get more efficient, so as NVIDIA makes better and better chips, you end up getting more efficient and using even more energy. And so even though the efficiency of the search is going up, your actual energy usage increases. So just another thing that's a tailwind for what we're looking at.
This is a great segue into the next part of this discussion, which is the inverse and levered single name ETFs. And we're going to get Tommy Bonville in here to talk about who's buying this stuff. NVIDIA 3X? Short players?
Well, listen,
long players?
anybody, there's no barriers to entry. You could log into your Schwab account right now, Sanjay, and buy some right ahead of NVIDIA earnings. So I come with a different lens. I'm obviously on the sell side. I'm a 25-year veteran in equity derivatives. A lot of volatility, swaps, structured, all different types of products, mostly on the institutional side. And what I'd like to talk to you about is, what's going on in the ETF landscape as it pertains to my lens, which is more equity derivatives. And that really is twofold. First and foremost is the inverse and levered ETF is not a new concept, right? It started off as a mutual fund, it transitioned to ETFs. They're out there across all liquid ETFs and indices. But as of late, it's actually catch a lot of traction on, I guess you start off with the Magnificent Seven, and now, with the AI craze, you probably start to broaden out. But there is appetite for more so because, the stock market only goes up and everything only goes up and to the right, more so on the levered long side. That's 2x. There are a lot of products out there that are also inverse levered, so maybe -1 or -1.5, maybe -2, depending on the underlier. But it's a massive change in issuance. There's obviously a change in who the companies and who the ETF issuers are issuing these products. And again, it kind of taps into whether this is just another manifestation of the Reddit craze post GME on a several year delay, or whether it's just the fact that there's real FOMO kicking in with market at all-time highs. But there's demand for products. There's demand from I'm assuming it's retail. I'm assuming it's professional traders. I'm assuming it's anybody and everybody that has a very short-term tactical view, because obviously these funds are rebalanced on a daily basis. And the real question is, well, Tom and Clear Street, why do you care? Our little entrance into the foray is, we're one of the swap providers. So if you have an ETF issuer, 40 Act funds, your funds are at a custodian, somehow you have to figure out how to get leverage, you have to get borrows if you're short, and that's where a swap facility comes in. And so there are obviously a myriad of brokers that are doing that, and we're making a pretty strong push into that avenue. And I'd say single stocks is probably the newest version, maybe not the shiniest penny, the new penny. That's crypto. So there's a new issuance wave of people trying to figure out, what spot Bitcoin or maybe even Ethereum down the road, and is there inverse or leverage on those products as well? So that's something to keep in mind on the radar screen. That's not really here right now. Part two. Again, I'm trying not to talk my book, but I can't help myself, is income ETFs. And so, income ETFs are not new. Start off as mutual funds. I'm sure a lot of fund managers just across the board, whether you're retail or institutional, have some kind of income or option overlay program. But, zero DTE has kind of erupted, and there are a lot more versions of income ETFs. So, it used to be you had large cap and small cap and mid cap ETFs, and they had cover call right strategy, and it was very easy to understand and help people diversify their portfolio or add a bond alternative. And now, there's issuance on, thematic ETFs that have a call overlay, put call combos that might have a call overlay, thematic baskets or themes just in general with call overlays. So it's one of those things, again, if you're an ETF issuer, you're using a custodian, custodians are not OCC members, so they can't hold these options. So it's something that's kind of making its way back into the derivatives world, because you have to be able to hold the options on your books and obviously service the accounts in terms of transactions and maintenance of those option positions, because most of them are short.
I think that's a great point. I mean, these income ETFs have exploded in AUM. Look at JEPI, the JP Morgan Premium Income ETF, and the JEPQ, which is the NASDAQ Premium Income ETF. These pay monthly dividends. They're also smart beta products. They overweight, so they've become much smarter, and they're providing monthly income to a bunch of retirees out there who are still long exposure. And you're just seeing that in the options market too. You're seeing the VIX potentially being suppressed because of all this overwriting being done by all these ETFs. So I'm not saying there's going to be Volmageddon part two, but there is a risk of that, isn't there, Tommy?
Yeah, I don't want to spend too much time going into the the Volmageddon scenario, because that was certainly a perfect storm. Hopefully, it's not something we're going to talk about in the coming months. I mean, again, this is a FOMO market. This is a market where people want long exposure. The structured vol products that are out there, of course, they're always going to manifest in different ways, shapes, and forms. But the setup that created the VVIX unraveling was a perfect storm, literally. But the other part about this is again, not a new concept. It is something that also a lot of banks deal with risk-weighted assets issues. It's also, during times when calendar gets tough and banks hunker down, they want to do things that they're really good at. They don't want to do new projects. They don't want to do new workflows. They don't want to deal with different collateral treatments. And so that's something that we're, kind of laying into a little bit. Again, not trying to do a shameless plug, but I am. We're trying to spend a lot of time trying to help ETF issuers create solutions, because there's a demand for it, and a lot of these, there's not a lot of people that are willing to kind of roll up their sleeves and come up with. They're not new solutions. They're just a little bit more cumbersome than the traditional off-the-shelf offerings.
NVIDIA earnings are out in about 10 minutes. Tommy, what was the last thing you saw on the desk? Buyers of NVIDIA 3X or shorts?
I did notice the FOMC minutes did not help the overall FOMO going into it, but we'll see. I mean, for us, we're market participants, so it's really for retail traders and prop traders and the guys that are trading day by day, not your asset allocators really. But it should be very telling for the market at all-time highs. We'll see.
Ed, did you want to say something? I wanted to talk about the successful debut of all the Bitcoin ETFs, and we'll open it up to the forum here. I mean, I think the fact that all of them have been trading so well and amassed so much AUM so quickly. I think it was iShares' best launch ever, I think, for an ETF. Yeah. So maybe you guys can talk about that in terms of new ideas. Do you think this is going to spur, or just what your opinions are on the success of those Bitcoin ETFs?
I mean, the truth is there was just demand, right? So the most successful launch of a single ETF before this was GLD. I believe they told him it wouldn't work, and it garnered $1 billion in 3 days. So I don't know what the Bitcoin, the largest one was $2 billion in 3 days, I think. Do you know the number?
I don't know.
But it was larger, so it was the most successful launch. The truth is there's a million ideas that are all great. You just may not have heard of them, right? Bitcoin, there was just a pent-up demand because people didn't trust the accessing sources, like FTX, for example, to get into it so they could buy the product. But if you have an ETF, it's a much more trustworthy source. Even though the SEC took, a really long time to get it through, similar to how long it took. I think it took 9 years for semi-transparents to come out, and the SEC took 9 years to approve Vanguard's bond ETF as a share class of their existing, because they were worried about the daily divs being different. So the SEC does not move fast, and that can create pent-up demand. But for the most part, when you think of all the products that are out that we have, they're all different ideas. It's just a question of whether they resonate and people understand how and what they use them for in their portfolio. The truth is, how many financial advisors have a sleeve for crypto? They probably don't. So it's probably a lot of retail and a lot of advisors who are just trying to take advantage of something their clients want, so they say they can own it. Doesn't mean it's a large piece, but people are placing bets. And if you're curious how people think, if anyone can find the article in April of 2007, a reporter did an April Fool's joke where they put out a sink or soar. It was on the S&P 500. It went up 1,000 times that day and down 1,000 times. And they said one of them would go to zero every day, but they had an exemption to relaunch. The next week he wrote a follow-up to it and said he's concerned about America, because the only question he got from people was, how do I invest? So they're willing to lose all their money in one day, but they still wanted to take the bet. So a lot of what happens and can be pent up is bet. And if you think of all the publicity crypto's gotten, it's gotten a ton of And since they've been out, they've all been up. Crypto's up. So it's a question of what feeds people's appetites to go in. I mean, the JETS ETF had almost no assets until COVID hit, and then it had a ton of assets. So it just depends on what's right for the right time.
Well, it seems like the SEC is noticing, because we should expect a decision tomorrow perhaps on the Ethereum ETF, and it looks like,
One day.
yeah, and it looks like it will be approved. I think that's what's coming down the pike.
Let's see if I can figure this out. You think about GLD as well. Yes, it was a successful launch, but it really had staying power once, the option market and then all the relative value, people that were trading the commodity versus the ETF started, the cycle began in terms of creating liquidity in the funding markets. So I think, that's really the next thing that people are waiting for. So all these spot Bitcoin ETFs, there's a plethora of them. They've all raised a ton of assets. I think most people think that they'll make their way onto, the model portfolios at the bigger places. There's more demand, but really, if you want to start to see the liquidity profile increase, you're looking for the options listing, and then you start the relative value games between, the CME, futures, options, and all the other, funding games that Wall Street tends to play. But that is another additional layer of liquidity which will help the staying power for the product.
So you expect to see a 2x, 3x Bitcoin ETF eventually?
They're already in existence, but I think what is more interesting is the option part of it, because right now, if you are a prop investor, a retail investor, a hedge fund, and you're sophisticated enough to go into the wild, wild west called Bitcoin CME options, which is definitely wide bid offer. There's only a few brokers that do it. A lot of the big banks don't. But you could trade BITO, right? You could trade Bitcoin, which is on the Bitcoin future ETF. Those have listed options, and you could watch the open interest in calls and puts change over time, and it will obviously be skewed to calls because most people in crypto have diamond hands. But all of this, liquidity feeds liquidity, and so if the OCC, SEC, CFTC, whoever the governing bodies are that do come together, again, above my pay grade, when they do finally, or hopefully when they do finally approve something in the options market, the listed option market, that will be another layer of positive affirmation that this will have further legs.
So the fact that these Bitcoin ETFs were so successful, does that give you guys new ideas, Ed and Jeff? How about a Bitcoin miners ETF domiciled in Texas? I just came up with an idea.
So one company? Look, I mean, here's what I want to dip into the previous panel on this question. Right, if you think about it, there's a lot of new ideas out there. If you really look at the ETF marketplace, it makes up, about a third of all volume across all exchanges? You might know better than me as a guy who was a trader for a long time. But only 10% of those make up 90% of all the volume. So every other ETF could be considered illiquid in a lot of ways, right? 75% of all ETFs trade less than 50,000 shares a day. They are liquid, right? Even Bitcoin, if it didn't take off, there's enough of an undermarket where you can trade because it trades as liquid as the underlying security. So we're all going to come up with new ideas. Did anyone ever think they'd see a Texas ETF, a state ETF? Because if you did, I want to know what you're drinking. It would have been great. But realistically, there's a million ideas out there. Are they all good? No. But because they don't have the liquidity profile that he was talking about, because they don't have options, or they're not trading vehicles or hedging vehicles, they just don't trade as much. They're more buy and hold. And that's where the exposure comes in, and that's where most of the ETFs that we have are going to end up lying. Right? Single stock may jump up a lot because NVIDIA's earnings are, not out yet. But realistically, that's what you're going to go into. So we all have ideas. We all would love them to trade exactly like Bitcoin did and get billions quickly. Trust me, my board asks me every time I meet why we're not like that. But realistically, it's just a different marketplace that we're going to launch into. whether you're doing music, right, or leverage, or energy transition. They all have places. It's just a question of where they go and how you can trade them, because they're all liquid, especially if they're US-based. Anyone know a US-based ETF or individual security that you can't really buy? I mean, my God, I bought a penny stock 3 weeks ago. It was easy to trade and didn't cause any damage to the spread. So you can trade. It's just a question of what it comes back to is, can you use them and will they catch on?
So let's open it up for questions from the audience. Anybody have any questions for the panelists? Don't see any questions, guys.
We must be pretty boring, huh? Okay.
So speaking of NVIDIA, so how come, here in the U.S. we only have 2 times leveraged ones, whereas in the London Stock Exchange there's 3 times, in Italy, is that regulation or is that, what is that?
That is 100% regulatory matter. The 2x single stock phenomenon is actually relatively new as well. If you recall, I mean, it's probably a year ago, most of the levered and inverse products that were out there were, 1.25, 1.5 times, and only recently has the powers that be approved the 2x products. But yes, you're right. There is a disconnect. I will say that the products that are over on the London Exchange or maybe trade in UCIT form overseas can get that 3 times gearing, but that is not something that has approved here yet.
But we expect that to be coming because, I mean, the indices, like for example, there's 3x levered long financial services, 3x long, short financial services. You would expect that to come, right? Or
I do not get paid to be a regulatory authority. But no, I think the 2x was a stretch, and maybe in time that's something that's revisited. But that is definitely a jurisdictional call, and it's something that is overseas, but certainly not here.
What's your most fun product idea that you haven't launched yet?
I could tell you, but I'd have to kill you. No, we're looking at some pop culture ETFs that are capitalizing on pop culture. So something adjacent. We're in the process of filing something that'll be adjacent to a music ETF, very much revolving around popular culture.
Yeah, I would say, I mean, from my side, I'm definitely researching something that nobody's ever done before, but realistically, I wouldn't want to talk about it and give it to my competitors. So I don't know if it's exciting or not, but if nobody's ever done it, it's kind of fun.
What's something fun that you think your competitors should do then?
I really think they all should invest in my ETF. Truthfully, I think that'd be fun for me. And since there's competitors in the room, anybody want to raise their hand and take a shot? No? All right.
maybe Florida-based domiciled ETFs? Or just
No, actually, the joke is I should do a Texas ETF, long short, and short California, New York.
I think on that note,
That would go well in Texas. I don't know.
one more question.
One more question over here. So how do the, 90% of the funds are illiquid. How do they deal with NAV so they don't wind up being like closed-end funds?
So 90% of the funds are not illiquid. The volume on screen is only what's traded. It doesn't mean what has traded, right? So if you look up TXS, trades about 5,000 shares a day. But if you looked at the implied liquidity at a 25% under volume, you can trade 270 million in theory before you move the price. If you reduce that to 1%, you're still talking close to 10 million. So it's a question of how you define liquidity. ETFs were designed as a pass-through, so the liquidity is based on the underlyings, not what's on screen. And so every ETF is as liquid as the underlying security. Look, you had Brian up here from Virtu. I've seen Jane Street, GTS, ran the panel. Sanjay used to do this for a living. He got bored with it, decided to do something more exciting. But they'll all tell you, every ETF is liquid. It's just a question of what's your definition of liquidity, right? Is it a penny wide? When's the last time you saw like Amazon a penny wide? It's not. So why would you expect anything else to be? That's the issue. People have the wrong perception because we helped create it. ETFs are extremely liquid, but they're as liquid as the underlying securities. That's the most important part. Unless somebody puts in a 10,000 share market order at like 358, then they're not liquid at all. You're going to burn through a book because there's no quotes. You have to look at what the quotes are and leverage a block desk. Leverage the people that we're talking that know what they're doing, because those block desks, whether you're Schwab or B of A, whoever, they're going to get to the Jane Streets of the world, the GTS, the Virtus, and actually execute the trade. So they're all liquid.
Great. On that note, I think we're going to wrap it up. Thank you to all the panelists and to ETF Global for a great day.